marketplace in the City of London, the London Commodity Exchange, a complex of marketplaces dealing in commodities on which our daily lives depend. Markets of international importance to those who produce the commodities and to those who consume them. Here, in this arena, you see the world trading. Traders buying cocoa beans on behalf of clients in Japan, or selling 10,000 tons for a firm in France, or buying for the United States. These commodity markets, of which cocoa is just one, earn Britain millions of pounds each year in invisible earnings. These are markets in which London's experience and reputation serve the world. The commodities bought and sold here are the so-called soft commodities, a term to distinguish them from the commodities traded on the metal markets. Trading is done by the open outcry method, as you can hear. The busier the market, the louder the outcry. If a trader wishes to buy, he shouts out the price he is willing to pay. If another trader is willing to sell at that price, he shouts back. And the contract is made there and then. Each trade is recorded. The price is announced for all to see, the market price, created by the law of supply and demand, changing many times a minute on a busy day. These traders work for companies in the city. Here, instructions to buy and sell pour in from clients all over the world.
Allô, Marcos? Si?
Allô? 84,50 à 125.
32 lotes de agosto a 100 y 84.50.
Allô? You please buy 3 lots, August 84.50. C'est OK. Allô? 3 lots, 84,50.
Ok, Marcos, perfecto.
OK, merci.
Clients' instructions are passed on to the traders in the market. This fast, efficient communication system is vital, with market prices constantly fluctuating. This, like the other markets in the exchange, is known as a futures market, or, as it is also called, a terminal market. They mean the same thing. If you were to ask any of the people who work here what was the toughest part of their job, they'd probably reply, explaining to visitors what a futures market means.
Putting it as simply as I can, each contract on the markets here deals with a particular month in the future. And this goes on for 15 or 18 months ahead. We are dealing into the future.
Till October at 75. Buyer. How many? Seller. Buyer. 5.
These prices, varying from month to month, represent the international consensus of opinion of what cocoa, coffee, sugar, rubber, or the other soft commodities should be worth at a particular time in the future. At the beginning and end of each trading session, traders make their bids and offers, whilst a chairman conducts business. It is at these times, known as calls, that the market's official prices are established. At all times, they're dealing here in promises to deliver or take delivery of a commodity. But, and this is what can baffle the outsider, delivery rarely takes place, because the contracts are usually settled before delivery is due, by matching a sale with a purchase or a purchase with a sale. A cash settlement is made on the differences. Let's take an example to show it's not as pointless as it sounds. Mr. Chocolate Manufacturer insures against fire, theft, and other risks. But what he can't do is go to an insurance company and protect himself against the risk of his raw materials going up in price unexpectedly. And that can be a serious risk. This is where the futures market comes in. It enables Mr. Chocolate Manufacturer to hedge against future price fluctuations. In other words, a form of insurance. January. Mr. Chocolate Manufacturer contracts to supply a customer with a specified quantity of bars of chocolate at an agreed price for delivery in 6 months' time. he bases his price on costs plus profit margin. He reckons, for example, that his cocoa cost will be £800 a tonne. When he goes into production, he'll need 20 tonnes of cocoa, which he may not be able to buy at this time. To hedge, he buys 20 tonnes of cocoa on the futures market at £800 a tonne for delivery in 6 months' time. This delivery, as you'll see, will not take place. June. Mr. Chocolate Manufacturer, ready now to manufacture this order, buys his actual 20 tonnes of cocoa on the physicals market. That is, through his usual supplier. But the cocoa bean crop has been hit by disease, and the price has risen to £900 a tonne. Without hedging, Mr. Chocolate Manufacturer would be in serious trouble because he would have lost £100 per tonne on his purchase of cocoa. However, as he had bought £800 worth of cocoa on the futures market, which has also risen in value by £100 per tonne, all he does now is to sell his futures contract at £900, thus making a profit of £100 per tonne, and this covers the extra £100 a tonne he now has to pay his usual supplier. It's not only the manufacturer or consumer of the commodity who can hedge. The coffee grower in East Africa or sugar grower in the West Indies, who may have to commit himself to selling at a certain price even before he's planted his crop, can protect himself against a possible future drop in price. So these futures markets provide a service for producers, consumers, and merchants alike. The speculator can also use the market.
First, I think it's important to realize that the speculator represents a comparatively small proportion of the total futures market turnover. However, having said that, he does fulfill from time to time a very useful function, inasmuch as he is prepared to buy for delivery, shall we say, 12 months or 1 year ahead, or even more, when the manufacturers or the other normal buyers of the commodity are not prepared to buy. And therefore he enables the producer of the commodity who may want to sell.
The main purpose of these markets is to enable the world commodity trade to hedge, and thereby ensure against the risk of future adverse price movements. And that helps the ordinary shopper in the high street, because hedging has a stabilizing effect on prices. Promises, promises. Thousands of contracts a day, millions of details to be checked, registered, and documented. A task handled by the International Commodities Clearinghouse with its up-to-date computer technology. The clearinghouse also provides its users with essential safeguards and guarantees. Very few of the futures market contracts come to physical delivery, but the contractual promises representing these goods would be worthless if they did not have the potential of being carried out. The commodities are traded on the basis of standard grades which are regulated by experts.
Hey! How many? Fire!
London, conveniently placed in the middle of the world's time zone. In the morning, calls coming in from all over the Far East.
15 lots, and I'll revert later, okay? Right.
In the afternoon, from North America.
July 1409.
London, where the world trades in markets that have a past and, of course, a future.
850 for October, December. 4 for March. 300 for July.